Okay, it is time. We're going to take an in-depth look into options, and we're going to go over all of the strategies, all of the different types of methodologies, and this is not a lesson to try and get you to FOMO into options on day one. I'm going to say this right now. If you are not experienced in options, do not do options, especially do not sell options. Buying options and throwing your money in the trash is one thing, but putting your actual shares at risk by writing contracts is highly not recommended until you have sufficient experience in doing so. So that being said, let's move forward with the introduction, an in-depth look into option strategies. So what are options? Options are financial derivatives. So whenever you hear the term financial derivatives according to options, think of call and put. That's all that means. This is just a very straightforward lesson, unconventional. So keep that in mind. So options are calls or puts that give buyers the right but not the obligation. That's the cliche term that's thrown around. Not many people understand what that means. Basically, if you buy a call option, you are not required to purchase those shares at all unless it expires in the money at the strike price that you chose to buy the contract at. So for example, if you chose to buy a contract of GameStop at $350 that expired on September 24th, and you forgot about it and you left it in your brokerage account, and then market closes at 4:30 rolls around and you forget, and you go in there and you look at it and it expired in the money, chances are your broker is going to ask you to purchase those calls. Now, it doesn't always happen that way, but it's frequently the case. So that is the risk. If you're doing options, make sure you pay attention because it could change very quickly, very quickly. So you have the right but not the obligation to sell. As long as you're on top of it, you don't ever have to buy those shares. As long as you get them out of your possession before expiration, whether they're in the money or not, you do not have to buy them back unless they're in the money and they expire in the money. Just don't let that happen. So you have the right but not the obligation to buy or sell. And whenever you think buy or sell, this is where it's going to get a little tricky. Buy equals long, sell equals quote unquote short an underlying asset. So buy is long, right is short. So when you're when you buy a call, you can buy a call, but then let's say it goes down a lot and you want to sell that call, you're selling a call. That's not the same thing as the sell we're going to be referring to. So that's why I like to refer to it as write and not sell, because it's hard to differentiate between the two different types of selling calls. You can sell a long call that you have, but you can also write a call using underlying shares that you already have been holding. So keep that in mind. So the agreed upon price is the strike price that you select. You're betting on it hitting that price by the certain date that you also select. So you are in control of a lot of these scenarios. You get to decide, am I going to buy a call or am I going to buy a put? And you can also decide, am I going to sell a call or am I going to sell a put, or write a call, write a put? At which point you also determine which price you're going to bet on or place your bet on that is going to reach by that expiration date that you also pick. And then where the Greeks come in is how all of that price action moves over the lifespan of the call. But we're not going to get into the Greeks. I'm going to try to stay away from that, as that tends to get very complicated. They are necessary in advanced strategies, but for the most part, we should be okay avoiding them for the most part. I am going to touch on the important parts, but in general, we're not going to go too much into depth on that part. So call options and put options form the basis for a wide range of option strategies designed for hedging, income, or speculation. If you've all done your options applications for your brokers, you had an outlook strategy. It likely asked you one of these three things. So hedging is to reduce your risk, whichever way the market goes. If you're hedged, you're minimally impacted. That is the purpose of hedge funds. Income, you're all offense. you're trying to make money. You're going long, you're buying calls. And then speculation is different strategies, advanced strategies, futures, things like that. Now, futures do operate a little different, so we're going to stick it into the realm of options for now. But futures differ that you do have to, you actually are obligated to buy your shares in futures, but we're not going to go into futures. We're going to stick this to options. So basically, there's different strategies, there's different techniques, there's a lot that can go in, but if you keep it simple, it's really not all that bad. So if you want to write a call, if you want to sell a call, which this is the part that no one really does. A lot, most people, especially in the GME AMC scenario, are just FOMOing long calls. And then they try to sell them, for a 99% loss at the day of expiration, or maybe they get out at a 50% loss after they see it go against them so fast. That is different than writing a call. So when you write a call, let's say you've been in AMC, been in GME for 3 months, you've accumulated 200 shares. You now have the capability of writing up to 2 option contracts. So what you would do and how it works is basically you have four different ways you can do it. So whenever you sell a call, let's say GameStop just ran up to 250. It's been about 2 months since we've ran. It just ran up to 250. Calls are up thousands of %. When you purchased that call originally, you had to pay a debit. You paid out of pocket immediately for that call. Now, when you sell that call for profit at the top, and you get that profit back into your account, then what you can do is you can turn around. You can buy puts for the way down. You can also sell calls for the way down at the same time. And then that way, on the way down, you get your credit immediately from selling, because when you sell a call, you get the credit immediately put into your buying power to use in case it goes against you and you have to buy it back. So if it goes against you, now you have the cushion there to purchase that call back if it goes the other way. So that's what the credit is for. That's why they're giving you premium, because it would be pretty fucked up if you sold a call, the price started going up, in other words, against the call writer. Therefore, you'd be losing money and you want to buy it back, but you'd have no money to buy it back with. So that's why they give you credit. So when you buy, you get a debit. When you sell, you get a credit. And it's highly recommended, especially for beginners, that you keep that credit in your account just in case the stock goes against you, so you have the majority of it to buy it back. Because let's say you spend that credit that you get immediately. What are you going to do if it goes against you and you don't have that money to buy the call back? If it hits that strike price, that's not going to be good, because then you're going to sell for a much lower price than you originally wanted to. So that's the risk you run. You want to keep it simple, stupid. That's the approach. So you go long, but then you also hedge on the other side. That's what people don't do. They only play one side. There's 2 sides of the market. You need to use them. Common mistake many traders make, they only play one side. When you sell options, you receive a premium up front that is instantly credited to your buying power once you write or sell the call option. This means that per contract, you're using 100 of your own shares that you've purchased as collateral and have the premium credited to your account in case you decide you need to buy the contract back. And the reason I'm putting these colors here this way is because it's counterintuitive. So when you buy the contract back, you're technically short. So that's you closing out your position, which is why it's red, from the market to close out your position. For example, if the stock starts going up after you sell a call, you'd want to definitely buy it back, because if the strike price is breached for the sold contract, you run the risk of having your shares sold into the market by your broker. It's counterintuitive. If the markets are moving, there's money being made. That's what needs to be remembered. Selling calls is how market makers rake in premium, but are likely done using naked options, because, again, who's got shares of GameStop that's a market maker? So what they do is they sell calls at the top after a run. People that think the run's going to continue, they buy all these options, and you see the volume skyrocket. The open interest doesn't change, because open interest is sold or written calls, and volume is bought and sold trading hands. As far as you and I, if we know what we're doing, we can use our accumulated shares to write contracts after the top of a run. When they expire worthless, guess what? That credit that we got up front is now ours to keep, and we can use it for the long side. So imagine being that person that's having your calls expire worthless all the time. You can literally be on the other end of that at the same time, so you wouldn't have to feel the effects of it as badly if you do it appropriately. So clear your mind, take a deep breath. Think of this as one color, not two. As long as there's a color, there's money to be made. If it's going up, you're good. If it's going down, you're good. You just got to know how to put everything in place to ensure that no matter what, it's going to be beneficial for you. That's entirely possible. This is why buying and holding is so easy, because you accumulate, you play the options strategies, you get free money, you buy more long, you accumulate. It's a big snowball effect. Because instead of only buying calls during hyped events by the media, for example, Ape Day, Gorilla Day, Bastille Day, you were aware that it would be a good idea to also use some of those shares you've been diamond handing and put them in to work in the form of calls that you've written. If done properly, this is how you accumulate more GME shares for free despite where the stock moves. So guess what? Even if we consolidate for 3 months, and if you play the options right, you can garnish more shares. So again, do not attempt this strategy unless you are practiced, as you run the risk of selling your shares if you fail to purchase the contract before it reaches the strike price in many cases. So if you're not one of those people that has the ability to look at your position and what it's doing all day, I wouldn't recommend it. Red is green, green is red. You just have to know which side to be on at the right time. This only comes from experience, in my opinion. So we'll look at the actual strategies next time.